Hello and welcome everyone to another StashAway commentary. My name is Philipp. I'm heading partnerships at StashAway, and with me I have again our Chief Investment Officer, Freddy.
Hi.
We're all good, and I'm excited actually for today because today we'll talk a little bit about the last quarter, kind of do a little recap, right, and kind of see what does the future look like in the near term, right, and also in the long term. And go into that in a little bit more detail. But before we do that, I have a couple of things that I have to get through. And the first items surround our StashAway Academy. That's our educational arm here at StashAway, where we do all the events and educational topics that we cover. With that being said, last week we finally launched our StashAway Academy websites in both Malaysia as well as Singapore. It's a great, actually, space that you can explore on our website. So it's stashaway.sg or .my/academy, and it actually gives you an overview of all the different modules that we cover in our educational academy part of StashAway. And the next couple events that we have coming up is on April 9th, both in Singapore as well as Malaysia. In Singapore, we're going to have a joint event together, and actually Freddy's going to be on the panel with State Street, and we're actually going to talk about gold and how does, maybe give a little bit more details about gold as an investment class, and also, the future of gold and how that might impact you. Yeah, exactly. So we'll do that next week. That's April 9th, and you can sign up via Eventbrite, or also if you just go to stashaway.sg/academy, you can do that there as well. In Malaysia, we actually have a seminar on how to plan for your retirement. So you learn a few retirement strategies there from our team in Malaysia. So that's also on April 9th. And again, you can do that also on our new Academy page as well. One other thing, on April 11th, we're actually going to do our first StashAway Academy webinar. It's going to be about financial planning, so you can actually sign up for it. You can listen to it at your own time as well, should you miss it. So it's very flexible, so I hope to have a lot of participation there and get a lot of feedback on how you like that program, and so if we should be doing more of those going forward. So that's everything surrounding StashAway Academy. Again, go to stashaway.sg or my/academy to find out more about all of that. So now let's get to the commentary part, Freddy. And the last quarter has markets seem to bounce back, right? So we had kind of the bottom of the market right around Christmas, right? 24th, 25th of December is the official the lowest part of last year, right? And now we're all of a sudden back in green, right? Great start to the year, best since 2009, best quarter since 2009. Can you maybe give us a little bit of recap, like why the sudden shift, and then also maybe go into like some of the asset classes and see what performed, what didn't perform, or did everything perform? Kind of walk us through that a little bit.
It's important to know that in 2018, the markets have to confront a few monstrous drivers. The first being that it's not a trade war. The first is actually the Fed. We have the biggest wave of monetary tightening seen in recent decades. It's not just about raising interest rate back to normal, because at the same time, I think we mentioned before, the Fed is reducing its balance sheet by $54 billion a month, was on autopilot for some time. That itself is called quantitative tightening. So we're moving from QE to QT. A lot of liquidity has been drained from around the world, right? So that's one of the main factors. Then adding to that, we have a lot of noises around trade war, and that created a lot of concerns and have a lot more impact on Chinese trade balances and emerging markets. So these two have really driven a lot of fear in 2018. And then I would say that that's two of the main reasons why we have two corrections last year. Now the rebound is essentially, when you look at the rebound so far this year, it's about where we are versus these two factors. The biggest one is that we have the Fed caving in, sounding a lot more dovish. We're no longer pricing for rate hikes at all in 2019. And the Fed also is also seemingly more flexible with how they're going to reduce their balance sheet going forward. Yeah. So that is a big fear factor being removed in the markets. And number two, trade war is now downgraded to trade talks. as Donald Trump has said, there's no hard deadline really. We're going to have ongoing dialogues. We're going to be very focused on cutting a deal that we can enforce and police and monitor. So that really diffuses this do or die by a certain time sort of deadline.
Do you think then, with that being said, just to chime in there on that topic, do you think then that is already, like, a trade agreement is already priced in now? Or do you still see that there could be potential, like a huge up spike, right, in asset prices once it actually starts? Because a lot of people are saying still, companies, especially American companies, right, they're kind of waiting right now to import anything, because why pay the tariff now when they know it's going to get removed again in a month or so, right? There's a lot of talk at least about it. Do you still think then that is it fully priced in already, or do you feel like there could be another leg up with a full agreement and actual agreement written down, right?
I would say the bad side of trade war has been priced in, meaning the negative impacts maximum has been felt. But the full upside of a trade war has not, the resolution of a trade war is not being priced in, because it's a lengthy process. The market is not really expecting a substance, a deal with a lot of substance. The market is also cautious about the trade tension returning again into the 2020 general elections. So I believe that the market is actually cautiously optimistic that this would not lead to a do or die scenario, but it's going to drag on. So nothing of complacency has been there in the market pricing at the moment.
Okay, no, that's interesting.
And that's a good news.
Yeah, no, exactly. So maybe before we move on and to some of the other topics, in terms of which asset classes have performed well, right? Like, it seems like obviously, like, if you've been globally diversified, everything kind of moves, or like your portfolio seems like it's up 10-12% for year to date or something, right? But is there any particular drivers that you've seen?
Well, if you look back at the two factors we mentioned, the Fed easing its stance has created a lot of reversal in the bond markets. And so government bonds, they are also positive return, but although it's a low single-digit return. But the impact on REITs, because as you know, real estate investment trusts, properties are a lot more sensitive to interest rates, and that's really particularly positive for REITs. In the US, REITs has performed a mildly, maybe around 16% by yesterday. And in Asia, it's about 12%. Singapore REITs is 12%. So the impact has been felt around the world, and that's really related to interest rate stance. So that's number one. And number two, we have a bit of misfire with the analysts guiding earnings lower. And things were not as bad as it seems. China PMI surprised a few days back positively. The PMI, if it's below 50, means that there's contraction in economic outlook, but it actually defeats market survey and went above 50. It was 51 versus 49. So I would say there's a lot of economic stabilization. Markets has priced what I think we're for a pretty healthy environment for investors.
Yeah. So no, I think that's a really good overlay now to the next quarter, like kind of what's ahead. We already talked about some of the things that are removed now, right? Kind of like where the market is humming towards, and earnings, right, is a big thing. But I think one of the other things that's on everyone's mind, because well, deadlines going past. First, everyone thought March was a real deadline for Brexit, right? For the longest, for 2 years.
Right.
Now we're already, it's the 3rd now, right, of April, and it's still kind of going on, right? And there's, I think by now, if you're like a normal listener, and I think I personally enjoy actually watching some of the debates, because it's hilarious how the government functions there compared to other countries, right? So it's very open and on camera, right?
Yes.
And very like still kind of like very traditional way how they do it. But how many times can you actually vote on something and vote against it? How many more times do you repeat the same process? But this is kind of now still on everyone's mind. There's still no solution, right?
Well, it's a political circus, not because the MPs in the House of Commons are jokers, no, but that's just that it's a very divided United Kingdom. You have the Irish border issue, and you have Scotland, you have Wales, who probably prefer to stay and remain in the EU, versus a less well-off parts of UK that wants to leave. It's a very divided nation. In the first place, a referendum should not have decided based on a point estimate. If it's 50.1 versus 49.9, is it really a case for Brexit?
We talked about this, right?
In our case, 52 versus 48, right, just if you recall, it's not a big enough a margin to say that we should leave the EU. So in the first place, it was a very, very ill-conceived way of the voting in the referendum. So the country is super divided. And the politicians are merely representing their own constituents in the House of Commons. When you can't look at the national interest and you just focus on your own constituents' benefits and interests, you can never work together. You can't even agree how to exit or how not to exit. So it's a stalemate.
So it's the same what we see in the US, right, with Congress and
this is far worse.
No, it's far worse, but like same thing. They're just looking out for their own constituents, right? There's no looking at the population as a whole. How do we make it actually better?
That's right.
So, with that being said, is there anything like you think about, like when you look at Brexit, any big market impact, or is it it's still, I think, very consolidated, not even on Europe, it's more on the UK market probably, right? Mostly.
Yeah, I think it's going to be very concentrated on the UK markets and some parts of Europe. The damages has been felt already for years. Things like businesses started to move to Frankfurt, even Paris, then especially banks, international investment banks, and so there's already been a lot of skepticism from the business side and a lot of adjustments. So I would say that from a game theory perspective, all this bad news and division is not a bad news anymore for markets because they are mostly priced in.
And I think that's it. And I think like one of the things you and I we always discuss is like the wall of worry too, right? There's still so much bad news out there, right? Like there's always bad news, right? Yes. So there's no one is super over enthusiastic about the stock market. So and this is normally what happens at the end of bull markets, right? People get really optimistic, just
I beg to differ actually. Well, they could reflect two things. That first is the bias from the news flow, because as you realize, we keep getting bad news coverage, not very good news coverage, number one. Number two, I would say that as the bad news came in faster, the market priced it in fast, so it didn't matter anymore. So with a lack of institutional participation, like all the fund managers are still holding a lot of cash balances, they're still being very cautious. It's actually good news, which means the recent rally so far, year to date, this so-called big rallies we have, is there's not a lot of participation from people who's managing a lot of money. And when they eventually get it, this is going to be, I think, personally, I think this is going to be a lot more upside from here, all right? But the worst is over, things are not getting worse than the news flow. If people came back in, it's going to be awesome. So I would say, let's just not focus on the new flows in the short terms. Let's just focus on fundamentals, focus on having your investment plans, right? Stick to it, don't react to it, you will be very happy by now.
And I think to close it off, I think maybe we can just use like 2 short sentences or something just to discuss these corrections that we've been hammering about. It last year was the exact same thing, right? They're very much V-shaped recoveries, right? They go down very quick, as you just said, right? The price in really quick bad news, right? And then from December 25th onwards, right? It's like this, exactly the same way, right? So you have this effect. So that's why it's so difficult to time corrections, right? It's almost like an impossible game to play, right?
Yes. And you're not meant to react to this sort of quick V's or multiple V's. There's just a lot. We call it the whipsaw. Imagine in the whipsaw, you're selling when it's low whip. When it went up, you go back in. It whipped down again. You get hurt twice.
And then you might not even get back in because now you think it's too high again, right? So it's very, very difficult.
Very difficult to time. So we would suggest that, look, we always recommend investors, even if you want to invest more of your net worth into a platform, split it out over a certain amount of months, so you average into the markets. When you're not having everything in a lump sum right away being exposed to the whipsaws, you are less likely to react emotionally to short-term volatilities, and that's a recipe for success. The ability to stay in and realize those long-term expected returns. That is what's the key here for us investors.
No, and especially like with long-term goals in mind, right? So for every investor, that's actually the way to achieve your goals and not, blow up the fort that you built, right? Anyways, well, thank you so much, Freddy. Really appreciate you giving us the little recap and look out for the next quarter ahead. Again, thank you all for listening. If you have any questions, concerns, you can write to support@stashaway.com, but you can also, in the comment section below, please feel free to ask any questions, and Freddy and I will certainly have some time next week as well to answer them. Right, Freddy?
Right.
Otherwise, I wish everyone a wonderful rest of your week, and hope to see you again next week.